Coming up today, Tesla continues its huge run, gold and silver moving up, Category 5 hurricane, more weak economic data, why the Fed's not ready to cut rates, Kamala Harris overtakes Biden, our favourite trader is back with a new investment, some financial planning 101, and one of Wall Street's last bears gives up. Let's go, guys. Hey, what's up traders and investors out there? Hope you're all doing well. Thanks for tuning in to the Daily Market Review here on this shortened trading day as we go into the 4th of July, America's Independence Day tomorrow, where stock markets will be shut. Stocks closed early today at 1 p.m. However, we still got some pretty decent volume and moves in what's normally a sleepy half day of trading. And once again, a bit more bullish breadth and moves out there. S&P 500 closing at all-time records, 55.37. Seem to be uncoiling a little bit from that contraction we've had over the last couple of weeks. Now got all defensive sectors, healthcare, staples and utilities underneath the 50-day moving average. But we've got consumer discretionary, financial, semiconductors, growth momentum stocks, and now high yield bonds back to uptrending. Most US indices finished in the green today, once again led by mega cap tech going on a run here. Dow Jones Industrial along with the Russell 2000 pretty much finishing flat there today. Volume breadth improving and actually breaking out to a weekly high there today. Similar deal on Nasdaq volume. Still got a bit more work to do on breadth though. 45% of stocks above the 50-day average and on new highs versus new lows, especially on the Nasdaq. Volatility still on the floor though with the VIX just above 12. And looking at the VIX 9-day, option deal is not pricing in any surprises or big moves come this Friday once we get the jobs report after we come back from the 4th of July holiday. Implied correlations just moving down lower. So much dispersion in this market. Stocks really doing their own thing here. Bond market volatility, a little bit more elevated than stock market volatility. There's a 2-year government bond yield trading sideways for a few weeks now at 470. Bit of a pullback for the 10-year as well after we had that good rip the last week, helping to stabilize TLT and the risk-sensitive high-yield bonds back above the 50-day VWAP. There's a dollar index pulling back and Bitcoin looking a little heavy here. Seems to be testing the support zone. May just want to give way soon and actually break through $60,000 a coin. We do have a little bit of support around 56,300, which it may come down and test. Same deal with Ethereum, looking a little heavy there as well. Commodities as a whole, pushing back up to multi-month highs. There's gold pushing off that support and crude oil looking a little persistent here as well. Hasn't had much of a pullback for over a month now. Nice bounce there for China. Smack bang off the 61% retracement from that last swing move. Same deal with clean energy. Bouncing beautifully off my buy-sell band there. And just looking at the largest stocks in the market, Apple, 3 white soldiers marching higher as well. Back to multi-month highs. Microsoft, all-time highs. NVDA bouncing back really good, up 4.5% today. The only one to pull back was Amazon, after it had been a bit technically overbought there. But once again, it's Tesla stealing the show and coming back out of everyone's rearview mirror like it has a strong tendency to do. Adding another huge 6.5% today, again on massive volume, 166 million shares, putting in the second consecutive upward momentum thrusting signal from my custom indicator, indicating really strong price action in the stock of Tesla here. The next earnings report still in a few weeks. They just came in with a really good beat on deliveries yesterday. Also got their robo-taxi presentation on the 8th of August, and we'll also get to hear more about how the Cybertruck is going as well. Good reasons for the bulls to get excited there. And the street's coming back around to them as well. Dan Ives was heavily critical on Tesla at the start of this year. Now he's back on board, saying they're setting up for a really good second half. And of course, a lot of the street is following, upgrading the stock, saying the worst is in the rearview mirror. And it too could be a big beneficiary of this AI boom as Elon looks to integrate more and more AI throughout all of his companies. However, not everyone's as bullish, and as long as there's Elon Musk and Tesla, there'll always be bears and doubters. This time we got Guggenheim sticking with their bearish stance on the stock, saying the financing promos on both the Model Y and 3 drove considerable volume growth, saying that demand has been pulled forward and that future demand will be challenging. They also don't see any more growth in their margin, which has also pulled back this last year as well, and they have a price target of $182. And there we are, trading after hours, almost on the cusp of $250 a share. I don't really do price targets. However, if I were to do one, I'd say we're more likely to hit $300 a share than go back down to $180. And just before I move on with the rest of the daily market review, I'm super excited to share with you guys, I'll be opening the doors for early access to my new stock pick service around this time tomorrow. Been working through the night to finish up the members area. Everything's running smoothly. And so if you want to follow my journey of turning a brand new trading account along with weekly contributions into $1 million, then make sure you're on my email list. As the stock market's closed tomorrow, I won't be making a video. And so if you want to be notified as soon as the doors open on my new stock pick service, then head on over to my website, clickcapital.io, click on the big red banner at the top and enter your email in this box here, and you'll be added to my email list. And I'll let you know around this time tomorrow, as soon as the doors are open, along with a 40% off discount coupon code, as I decided to open a bit early. A lot of people had emailed me saying they wanted to get my next pick, which I'll be sending out this Sunday morning at 8 a.m, as I will do every week. And inside the email, there'll be a document describing all the details of what my next pick will be, the stock that I'm going to be buying in my account this coming Monday. I'll tell you exactly what they do in plain English and why I like them, what their latest numbers are, and like I said, everything is 100% transparent. All the trades are made in my real money account after I send the picks to members, and you're about to see all details of the open picks, along with performance of the account, updated every Sunday, and screenshots of all the trades made in my account, uploaded in the members area as well. And this is a brand new real money account I've just opened specifically for this service, just using a simple app-based broker similar to Robinhood. And like I said, I've put everything out in the open so you guys can follow along and join my journey of turning this account into $1 million. Also, if you're interested in getting my online course, over 12 hours of on-demand content, or my 25 custom trading view indicators you see me use on the daily market review every day that I've developed myself over the last 8 years, then again, stay on the lookout for an email tomorrow because I'll be adding some new packages to my packages page, which includes the new stock pick service, my course and my indicators, and a new all products package, which includes everything. And I'll be offering 40% off on all those new packages, including my stock picks as well. So if you're interested in getting any of my products and this new stock pick service, tomorrow will be the best time to do it. And so if you want to be notified as soon as the doors open, then click the link below this video or come to my website, clickcapital.io, click the red banner up the top and enter your email in this box here, and I'll let you know tomorrow as soon as it's available to purchase. And I'm super excited to share this journey with you guys. I think you're going to learn a lot and really enjoy following me on this challenge. And so far, so good. Current portfolio of 4 picks. Had a good day today, and I'm in the process of researching what pick number 5 is going to be, the stock I'm going to buy this Monday. So stay on the lookout for an email from me tomorrow. Moving on with the daily market review. We got a monster hurricane on the way to Jamaica after causing widespread destruction in the Caribbean. Tropical cyclone has set a string of records as it's developed faster and earlier than what we usually see coming into hurricane season. Hurricane Beryl's actually been declared the strongest ever hurricane in July, having already been declared a Category 5. Winds reaching 157 miles per hour. And there's a look at its expected path over the coming days as it makes its way through the Cayman Islands, over top of southern Mexico, then looks to hit land around the Mexican border in southern Texas. So we'll keep an eye on that, and hopefully that doesn't cause any more destruction than what it already has done. And considering we've seen a bit of a reversal in crude oil inventories, big drop today, 12 million barrels, and we've still got heightened geopolitical tensions, this hurricane season could add to all of that, and we could very well see crude oil trading back in the high 80 in the coming weeks, again, which isn't good for inflation. Moving on to a bit of economic data, got ISM Services PMI coming in a bit weaker than expected today, another sign of softening economic data, potentially the US economy contracting somewhat. There's a look at a 5-year chart of the ISM Services PMIs, clearly downtrending and actually making a new multi-year low today. And this is in addition to a lot of other June readings contracting from the prior month, especially in the services area. And that's where we've mostly seen inflation this last couple of years. So this all could potentially help the inflation picture here. And in fact, the Fed could be coming to the party a bit late as global central banks as a whole are back on a path of easing, with 3/4 of them expected to have eased this year by the time we get to December. And even though Wall Street's doing well, AI spending, the stock market, or at least in large cap growth stocks, hitting new all-time highs, most Americans out there are saying they're financially worse off now than they were a year ago. In the survey question, I am not completely financially secure and likely will never be. That actually jumped from 26% last year to 30% this year, along with people claiming to be financially secure or hope to be one day. In other words, optimism in a lot of Americans has been declining and pessimism has been rising. From what I'd say is mostly from that still structural embedded inflation. Everyone paying a lot more for their food, rent and medical bills than they were a few years ago, and their wages just haven't been able to keep up with those same increases. And unfortunately, that's largely due to fiscal and monetary policies, which are outside of their control. We even got an economist I really respect, Mohamed El-Iran, saying the Fed could be on the cusp of making another policy error by not cutting, as he's seen plenty of signs of softening and weakening in the US economy, giving the Fed room to cut now. We now got a lot of CPI components moving down to 2%. Fed funds rate still at 5.25%. That's a pretty healthy margin for them to go ahead and just chop off 25 basis points. Wait another quarter and see how they go. However, the Fed meeting minutes show a lot of officials are still on the sidelines with rate cuts. Quite a lot of dispersion within the Fed as well. Some say there's still the possibility of another rate hike. Others indicating they're ready to go ahead with a cut pretty much now. But we've been hearing from Jay that they're not ready to cut until they have greater confidence inflation is moving down to that 2% mark. Some others have speculated that possibly the Fed is thinking that Trump's going to win now as well. They may not want to cut going into his presidency, and instead they may point to tariffs. And then if he gets in, maybe they actually want to do something about inflation then and start hiking rates next year. So if they went ahead with the rate cut later this month or in September, they don't want to have egg on their face, turn around a couple of months later and start jacking rates higher, which could be a reason why they're staying on pause. Maybe they just want to see how this election plays out, then make a judgment. And we're already seeing the media and what feels like deja vu from 2015, warning of the big risks if Trump's going to get back in, saying we could get the biggest stock market crash, or the market could just flat out collapse. The Trump trade war won't be good for the stock market. Guy who calls himself Dr. Doom. A recession if Trump wins is just the start. However, we're still yet to see whether Trump can actually pull it off, because apparently Biden's inner circle doesn't want him to go anywhere, saying no one is pushing him out, and apparently he's going to stand firm on running. Thinks he's still got another 4.5 years left in him. But as any doctor will tell you, when someone's got Parkinson's, dementia, or some other neurological disease that often comes with very old age, the decline is not linear. It doesn't just step down every day or every week. Sometimes it can fall off a cliff, kind of what we've seen with Biden the last couple of months, as he's really degraded. So is Biden and his inner circle doing what's best for America, or are they doing what's best for themselves? Because their legal pursuit of Trump looks to have failed, with the Supreme Court granting US presidents broad immunity from prosecution whilst in office. And so they've pretty much thrown the book at him with 4 criminal cases. Now it doesn't look like they'll be able to proceed, and Trump is fair game for this election in November. And in a continuation from yesterday's move, in which we saw Kamala Harris move up to almost 12% odds, and Biden was at 17, she's continued to break out, and she is now the Democratic frontrunner, second favorite to take the US presidency. Looks like someone already knows something. The decision may have already been made, but she's still going into it with very low odds. So let's see if they can pull a rabbit out of their hat this time again. And speaking of politicians, our favorite trader in Congress, Nancy Pelosi, lifetime politician, along with her garden variety fund manager of a husband, who've watched their home city turn to crap over their lifetimes thanks to their policies, whilst amassing a fortune of over $250 million for themselves. Yet she still regards herself as a public servant. Just made her latest trade, doubling down on their position in NVDA and adding a new position, Broadcom, semiconductor. And once again, they favor call options. They got 20 call options with a strike price of $800, expiration date of June next year. And I'll give the Pelosi's one thing. When it comes to options, they do know how to do it right. Because when it comes to buying options, you're better off buying deep in the money, far out, and the opposite's true when it comes to shorting options. You want to sell out of the money options nearby. So Broadcom, coming out of Palo Alto, California, just down the road from where the Pelosi's live, currently trading over $1,700 a share. They're along the $800 strike, so really deep in the money. And like you'll see with a lot of their trades, a year out, so they won't be paying much time decay theta on those call options. Plenty of time to cash them in or roll them out, and giving themselves a year puts the odds in their favor. And it's really just simple math, and why most short-term traders lose. If you don't have a real edge in the market, you're pretty much just gambling in the short term, 50-50 minus the spread and costs, and you'll be beat by the algos. However, the longer you hold, the more likely you'll sell for a win. That is if you've got a good stock. Just looking at the probability of negative returns based on the S&P 500. If you hold for any 1 year period, you've got about a 26% chance that you'll sell it for a loss. I'd say the same goes for a good stock. And that's something I do in my own investing as well. My new stock pick service. Average hold time will be around 6 months for all investments. Losses will be a bit lower and winners will be a bit longer. In fact, some positions I could be holding for up to 2 or 3 years. As long as everything's moving in the right direction, we're going to be running winners as much as possible, chasing those outliers. Really looking to invest in stocks that have the potential to go up 100% or more in under 2 years. Anyway, back to the Pelosi's trade. There's nothing to see here, because as she'll regularly tell you, she said she's never given her husband information about upcoming federal policy or anything that could potentially give them insight into the industries and companies that she actually helps to regulate. And in fact, an ETF that tracks the trades of Democrats in Congress has been smoking the S&P 500. You can see that in this chart here. Ever since these new ETFs come out, that track both sides of America's 2 political party system. The Democrats in the blue doing a lot better than the S&P 500 in the black. However, the Republicans not doing as well, only up 15% with their trades. Also interesting, we're still seeing big insiders cashing out as well. Jensen Huang's now offloaded almost $170 million worth of shares just in June alone. When we first got news of that, stock put in this big bearish engulfing candle, pulled back somewhat. However, we haven't even touched the 50-day VWAP. Looks to already potentially be finding some support here. And according to Nancy Pelosi, there's still more room to run. Moving on, we've got one of Wall Street's last bears thrown in the towel. The guy who I said just 2 weeks ago was still out on a lone island, having a much lower price target on the S&P 500, JP Morgan's Marko Klanovic, leaving the bank after a series of big bearish calls, showing that career risk on Wall Street is real. If you want to stick your neck out and go on a lone island, you do take the risk of having the spotlight on you and getting pushed aside. That's why most of Wall Street naturally acts like a school of fish, just trying to blend in, not take any career risk, and just basically follow the crowd and follow the price. This comes just a few months after we saw a similar bear, Mike Wilson from Morgan Stanley, leaving the firm's global investment committee after him too was stubborn on his bearish calls for a couple of years, having to throw the towel in as well. Now we've even got another Wall Street company, Piper Sandler, no longer going to publish S&P 500 targets after they too completely missed the mark. But I will agree with them on one thing, putting these year-end targets, I mean, it's good entertainment, but no one can guess where the market's going to end. We can just make our forecasts and look at history, but it's such a dynamic thing. So many things can happen and change. So publishing a year-end forecast at the start of the year, it is a bit of a fool's game. But just goes to show how beat to death the bears are, not only in this market, but the last 15 years. Short-only funds, persistent bears, and on any given normal year in the market over the last 100 years. Tough to be a bear for all those reasons I shared with you guys a couple of days ago. Stock market has really strong structural reasons for moving higher over time. Retained earnings largely being one of them and underestimated by most. Not only that, but we live in the era of Federal Reserve-sponsored corporate socialism. Markets and big businesses are not allowed to fail. They'll get you, the taxpayer, to bail them out, creating that moral hazard. All upside, no downside. They'll print money, they'll do whatever stimulus, whatever new program, they will not let the forest burn down. And while sure, we're going to see another bear market at some point, does anyone out there really think the Federal Reserve's not going to come out with quantitative easing version 5? And how many trillions are they going to print this time to prop up the markets? So whatever bear market crash pullback there is, could just be like March 2020 and COVID. Lasted a bit over a month before it set up for the biggest rip in history. So we should have free market capitalism, natural market forces, let things burn down, rebuild up better and stronger. However, the reality is we don't, and being a bear is likely to remain tough for many more years to come, even when we do get that down year or two. And that's why I prefer to go forward with diversification instead of trying to completely stay out of the market or get heavily short. That's just too hard a thing to do. And one area of global markets that I do think is offering up a good opportunity at the moment, both in terms of valuation, earning a dividend yield, as well as a low correlating asset to the US stock market, that's Brazilian stocks. Market heavily tilted towards the commodity space, and even though they have their moments, still a relatively stable political and social system relative to other developing economies. And looking at the correlation between the S&P 500 and the Brazilian stocks ETF EWZ, looking at annual returns over the last 23 years, Brazilian stocks have a positive 47% correlation with American stocks, which is pretty good, meaning that will increase the diversification in a portfolio. Not only that, but looking at some valuation metrics along with their growth, some of the best in the world at the moment. There's their forward PE at 6, price to sales at 0.6, one of the best price to free cash flow 2.3, and earnings are still expected to grow as a group over the next 5 years. And the good thing is there's plenty of large investable stocks, even listed on the New York Stock Exchange as American Depository Receipts, ADRs. And there's a list of some of the biggest Brazilian stocks that trade on American stock exchanges as ADRs. Not only that, but the Brazilian stock ETF from BlackRock's iShares, EWZ, the most popular one, very healthy dividend yield, 7.86%, and very diversified as well. Biggest position in Vail at 11%, and other commodity companies as well is exposed to. Technically speaking, on the daily chart, we may have just put in a bottom here. Plenty of volume, really good divergence on my DSI. Huge amount of institutional buying. You can see my indicator really green here. And even though it was a half-day trading in America, still put in above average volume. 33 million units traded, moving up 3.2% today. And there's a long-term monthly chart, potentially finding support at the bottom of this multi-year range. And with the help of a commodity secular bull market, just maybe in a few years' time, we're looking back at $28 a unit as being really cheap. Because just like small caps, when emerging markets and commodities move, they move like crazy. And we saw that in the last commodity bull market, kicked off in the early 2000s. This Brazilian ETF actually went up over 2,000%, 20x gain in under 6 years, of course, before it had a really sizable crash and correction. So whilst it's been sleepy here for a while, I wouldn't be surprised in the next couple of years if that next big bull market is just around the corner somewhere. As always, this is just my opinion and analysis. It's not financial advice, so please do your own research before making any investment. And so in yesterday's daily market review, I showed an example of the benefits of dollar cost averaging, even into a really well-diversified portfolio of major market assets. Had a few people reach out to me saying they really enjoyed it and they've been learning a lot. And so I thought I'd offer another quick and easy lesson today on Financial Planning 101. I know a lot of you guys understand this, However, it could be a good refresher. And for a lot of us, we didn't really get a formal financial education. I was lucky enough to get a diploma in financial services after leaving school, and I've always had a strong interest in personal finance, stock markets, and investing. However, for most people, school curriculums around the world just don't teach us even the basics when it comes to personal finance, saving, investing, taxation, insurance, estate planning. So it's a bit funny, isn't it? We all get taught math and science, the arts, but nothing to do with managing and growing our wealth. I guess maybe because not everyone can be a millionaire. Who knows why? Luckily, we have channels like Click Capital, and so hopefully I can explain this in a simple way that makes sense. So just to visualize what a lot of people's financial journeys over their lifetimes could be or should be, you could pretty much divide your financial life into two parts. Your working years, which for most people between the age of 20 and 65, some a little less, some a little more, and then your retirement years, which is hopefully for many years after you finish working. So the goal for most people before they retire at age 65 is ideally you have a house paid off, so you've got no mortgage and rent, you've got a nice fat retirement account, whether that's your 401k, superannuation, KiwiSaver, whatever tax advantage retirement account there is in your country. Typically the best ways to accumulate financial assets over the long term, keep you locked in, low tax. But then it's also a good idea to have some personal brokerage accounts, maybe one or two, no more than three, so you don't want to overdo it and be bogged down in management. And so the idea when you're retired is you've got no rent or mortgage and you've got some nice monthly income from both your retirement account, your brokerage account, and also maybe the state pension. Most developed countries give you an age-based pension that can also help complement the income from your nest eggs. So through your working years, up until the age of 65, your income is going to largely correlate with your nest eggs at the end of your career. So anything you can do to maximize your income, whether that's level up with your skills and education, negotiate with your boss, try and level up with your job, side hustle, anything like that's really going to help you at the end of the day. And of course there's taxes. For the most part, none of us can do a whole lot about that. They can be legally minimized. Then you've got your personal expenses. Like I said, you want to keep frivolous spending to a minimum, try and be a smart consumer, buy in bulk, other things like that. Then after taxes and expenses have been deducted from your income, you'll be left with savings. And like I showed you yesterday, the best wealth building strategy through your working years is to regularly contribute, paying down your mortgage, regularly contributing to your retirement account, and also some personal brokerage accounts as well. And here's another way you can visualize it, building your nest eggs. While you're working, you want to contribute to your accounts, reinvest the dividends, ideally not withdraw anything, just build up your nest eggs, enjoy the journey, and then when you retire, you obviously stop contributing and you can withdraw small amounts each month from your retirement and your personal accounts. And so financial planners will recommend a good rule's about 1 to 4% per year of annual withdrawals from your nest eggs. And that depends on a few things: the size of your nest eggs, what sort of income you require, if you've got kids and how much you want to leave to them, or other things you want to leave money in your estate to. But you basically want to plan if you're able to make it to the age 100, you've still got some income. Nobody wants to die old and broke. And so I'll give you another visualization of what that could look like. And again, using my example portfolio from yesterday, where a quarter's in stocks, quarter in bonds, quarter in REITs, and quarter in gold. And so that diversification helps lower the volatility and drawdowns in your portfolio. It can benefit in times of inflation, times of deflation, different parts of the business and economic cycle. Your portfolio can hold up really well all the way throughout. So just editing the portfolio settings. Let's say, for example, we started with $1 million and we withdrawed a fixed percentage per month, 0.2%, which if we multiply 0.2 by 12 months in a year, that's about 2.4% a year, which is a good middle ground. Like I said, ideally you want to withdraw between 1 and 4% of the portfolio per year to kind of keep it sustainable. You really don't want to go too much over 4%. So let's say we withdraw 2.4% of the portfolio per year, which is 0.2% per month. Let's take a look at how that would look over a long period of time, 30 years. If we were all lucky enough to get 30 years of retirement. Well, the good news is the starting portfolio of 1 million still kept up and beat inflation, finishing at 4.7 million. And that's really the goal in investing, especially in your working years. So you want to grow your wealth at a faster clip than inflation. Because if inflation's outpacing the growth of your wealth, then you're on a path to zero. That'll affect your standard of living. And there's a look at the portfolio equity curve over that 30 years from 1994 to 2024. And here's a look at the annual withdrawals. So there's the first year, 23,000. Like we said, about 2.4% per year. And the good news is with that diversified portfolio and selling 0.2% of it per month, your income still increased every year. Only dipped down a little bit in 2008 and 2009. And for last year, it would have given you over 103,000 in withdrawals. So far this year, over 55,700 at the halfway mark. And like I said, the good news is the portfolio still beat inflation. Would be worth 4.7 million, and that's starting with $1 million 30 years ago and selling 0.2% of it every month. So that's just a little bit of financial planning 101, and just wanted to share that with you guys. I know a lot of us haven't really been taught personal finance, let alone investing and everything else. But the idea is dollar cost average when you're working, save what you can while still enjoying the journey, paying off your house, and then creating some nice big nest eggs that you can slowly sell down, hopefully through a long, comfortable, and enjoyable retirement. And if you found that helpful and would like to learn more, then like I said, I've got an online course called Trading, Investing, and Wealth. Master the Markets to Achieve Your Independence. It's got 25 modules you can watch on demand and stream to your TV. And like I said, if you're on my email list, I'll let you know tomorrow when I've got the new packages available that include my new stock pick service, along with my course and my indicators, and you can get 40% off everything. This is the biggest sale I've ever had. And so if you're interested in getting this stuff, tomorrow will be the time to do it. And if you haven't already, just head on over to my website, clickcapital.io, click on the red banner at the top, enter your email into this box here. Make sure you confirm your request with the email that'll be automatically sent, and stay on the lookout this time tomorrow. I'll send you an email, letting you know when the doors open for my new stock pick service, and you'll be able to get instant access to the private members area backend, and you'll also receive my next stock pick that I'll be sending this Sunday morning, going over details about the stock I'll be buying this coming Monday. And so I'm really excited to share this journey with you guys. I think you're going to find a lot of value in it. As far as I can see, nobody else out there is doing anything like it. All other trading memberships and chat rooms and Discord servers and all this, just calling out trades after the fact. There's no transparency, there's no accountability. Don't even know if they're really trading them. Whereas with me, all trades will be made after I send the picks out to members, along with the exit alerts as well, and screenshots of all my trades will be uploaded in the private members area. So like I said, the stock market's closed tomorrow for the 4th of July. I wish all my American friends a happy Independence Day, and I look forward to opening up the doors to this brand new service around this time tomorrow. All right, guys, that's all for today. Thanks very much for tuning in, and I'll speak to you again soon. Cheers.